Hello, hello. Welcome, everybody. Great to see everybody joining early once again. Hey, Daniel. Hey, Raw. Get IOTA. That's a great username. Kilian. Urbanbra. And somebody from Asia. Hello there. All right. We got quite the lineup today. Very excited about today's episode. We are going to be exploring a little bit about Gamma and liquidity management strategies. So yeah, I'm very excited to be leaving this space, hopefully a lot smarter. So yeah, grab a drink. We will be kicking off in roughly a minute. Yeah, let's give it one more minute and then we are ready to get started. And we have BP requesting to speak. Awesome. Let's get you up on stage.
Hey, how's it going? Yeah,
Hey,
sorry I'm a few minutes late here. I actually was on the Google chat instead of the Twitter space, so apologies for that. But
no worries, no worries. It's all going to work out fine. Very glad that you're here. We have quite a bunch of people being very interested in what you're about to tell us. So, yeah, awesome.
Awesome. Yeah, glad to be here.
Yeah, great to have you. So, let's get right into it. So starting out, this is Buildsphere number 7 already. Thank you, everybody, for joining. Thank you, Brian from Gamma Strategies for coming up to talk a little bit about the format that Buildsphere wants to portray. So we are wanting to give the community access to the projects that are populating the IOTA EVM. We want to give an introduction. The community has the chance to ask questions. We have a chance for everybody to get on stage at the end of this space. If you have any questions, then please raise your hand and then we'll get you on stage. All right. Also, if you have a project that you want to be featured here on Buildsphere, you can also apply in the link here in the comments, and we will also regularly repost that. So if you're running a project or you know somebody that does, that should get featured here on Buildsphere, then please fill the form and we will be in touch. All right. I'm your host, Jonathan. Today we are joined by Brian from Gamma Strategies. So yeah, let's start out with an introduction of yourself and the role that you play at Gamma, please.
Yeah, sure. Thanks for having me and happy to be here. So I'm Brian. I'm the project lead at Gamma Strategies. We're an active liquidity manager on Uniswap v3 and other code bases that are built on the Uniswap v3 contracts. The role that I play at Gamma is I pretty much oversee all the different departments going on, namely the smart contract side, the front end, the back end strategy, the data side. So I'm sort of like, I guess the conductor that just kind of makes sure everything is flowing correctly. But yeah, that's previously I wasn't an original founder. I was originally a community manager back in the day in 2021, and then I just sort of was very, very interested in the project and what they were building, and yeah, I'm currently leading the project today.
Sweet. Yeah, that will put you in a perfect spot to be answering some of the questions that we have prepared for you. So initially, I would like to know, how did Gamma come to be? Like, what was the idea that drove Gamma into existence?
Yeah, so we started back in 2021, and this was when Gamma was. This is when Uniswap v3 first came out with its new design schematic. So, not sure if you're familiar, but the main difference between Uniswap v3 and Uniswap v2 was this idea of concentrated liquidity, that you can concentrate the liquidity around certain price ranges, whereas before in v2, you were only able to provide full range of liquidity. And what full range liquidity is you're essentially providing liquidity, let's say in an ETH USDC pair, you're providing liquidity from when the price of ETH is 0 to the price of infinity. And what concentrated liquidity allowed is, instead of spreading all our money across all the different price ranges to provide liquidity, we can concentrate that liquidity. If ETH is trading at 3K, we could concentrate it between 2,500 and 3,500, and by virtue of doing that, you significantly lower the price impact for the traders. And so we thought this was going to be pretty innovative, and it was going to sort of change the way that DEXs and liquidity providers were going to provide liquidity. The only issue with that is it just introduced a lot more discretion, I would say, because there's a lot more possibilities now. Instead of before, there was only one possibility. You provide liquidity from 0 to infinity. Now you can provide liquidity from maybe, a plus or minus 50% range, a plus or minus 25% range, and how that affects you financially, how much divergence costs you incur, how much fees you accrue. Like, it's very, very difficult for a normal liquidity provider to kind of make these assessments. So we thought there was space there for us to add a lot of value, and we created this platform where we're deciding what ranges to provide in based off the statistical analysis that we've done on these pairs, backtesting strategies, optimizing certain parameters that will lower the cost of providing liquidity and look to maximize the fees that we're earning on our position. So it was really that new paradigm shift of Uniswap v3 that motivated us to build our product.
Yeah, that is great. I mean, I have been providing liquidity in both V3 and V2. And of course, V3 does require a little bit more planning, probably also a little bit more expertise. So, very excited that you are setting some parameters here that should hopefully make it easier for people to, provide liquidity in a range that makes sense and is also, potentially having some yields. That is definitely something I'm very excited about personally. But let's talk a little bit about this space happening. I think people might have an idea that IOTA and Gamma strategies are going to band together in the near future. Maybe you can let us know about these plans a little bit.
Yeah. So right now, within the past few weeks, we've been really trying to see who we're compatible with. I know Tangle Swap, we got in contact with quite a few DEXs. So Tangle Swap is one of them. There's another one called WAGMI that's also using the Uniswap v3 code base. But essentially, any DEX that uses the same tick math. So the main innovation behind Uniswap v3 was their tick math library. And by what that means is you can each liquidity, you could provide liquidity in different ticks, and there's like 887,200 times 2 ticks within a specific pool. And the way that the liquidity moves through the different ticks, it's based on a certain swap, is all utilizing the Uniswap v3 tick math. And that's what allows Uniswap to be so capital efficient. And many other DEXs have either licensed or forked that tick math from Uniswap v3. So those are the main DEXs that we're compatible with. So basically, our plans are to integrate with as many as possible that are compatible with that. Right now, it's Tangle Swap that's been that we've interacted with, but there's also, as I mentioned earlier, WAGMI DEX who's also looking to be onboarded, and I've heard through the grapevine that other DEXs are coming on soon. So that's currently it at the moment. We're looking for new integrations and for compatible exchanges to launch on.
Awesome. I would take that as an invitation. If you're running a DEX, if you're running an AMM, it sounds worthwhile to get in touch with you for an integration here. Is that fair to say?
Yeah, definitely.
Awesome. Yeah, let's talk a little bit about the Gamma token. It relates to the range of services available on Gamma strategies. So please give us the rundown on what the Gamma token is about.
Yeah, so the Gamma token right now is essentially it's just a revenue generating token. Users can stake the Gamma token, and then they'll receive a portion of the revenues from the liquidity positions that we're managing. And that's pretty much it. But we're looking to find ways. So I think different protocols do it different ways. Like for us, for the long period of time, we've been trying to find just product market fit, which I think we found, and looking to introduce ways that we can further decentralize our token and introduce governance. So, some of the ideas that we've had in mind, which are not live today, is users can stake Gamma to earn Gamma, which is our protocol revenues. But later we're going to introduce you could stake Gamma to earn ETH on Ethereum mainnet. Right now we're only currently on Ethereum mainnet, but we may potentially move to other chains. But essentially, we're also looking to see ways that we can introduce voting, where we can vote certain portions of our revenues to different pairs, where people can incentivize certain pairs that are maybe generating a lot more in fees and things of that nature. But that's currently what it is at the moment. Right now, you could stake it to earn more Gamma, but we're looking to introduce more areas of decentralization soon.
Awesome. Yeah, let's dive into the strategy part here of, Gamma strategies. And I would be very much interested, like, what kind of strategies do you see people use? I mean, obviously there is somewhat of a learning curve to it. So yeah, maybe let's take it from a very basic strategy and also mention somewhat of the advanced gigabrain stuff that people could potentially do.
Yeah, so the strategies are really pair dependent. It depends on the volatility of the two asset pairs. So there's very correlated assets, like obviously the stable coin pairs, like let's say USDC and DAI, they're almost one for one peg. Those will have a much different strategy than, let's say, a very volatile asset pairing like ETH and USDC, which are non-correlated. And, sort of in between would be like two correlated assets that could diverge with each other, like ETH paired with BTC. So each one of those strategies, based off the volatility of the pair and the level of correlation of the two assets, are going to have a different strategy. Obviously, the stablecoin pairs and maybe the LST pairs, like Wrapped ETH paired with ETH, those are going to have very, very tight ranges within a few ticks. And that's really because you won't expect the price of those assets to diverge wildly. And it's important to remember that when you are providing liquidity, you are essentially short volatility. So if the asset prices were to diverge, then you as a liquidity provider will experience some amount of divergence losses. So, and the more narrow you are in your position, the more short you are volatility. So to go narrow with your ranges is a very aggressive strategy while you are earning more fees. What a lot of LPs don't consider is the divergence costs. So let's say if you're providing liquidity in ETH USDC today, as a liquidity provider, you're always taking the opposite side of the trade. So if ETH is going up, that means the traders are putting USDC, paying you USDC in exchange for ETH. So ETH is coming out of your position and more USDC is coming in. And meanwhile, because they're buying ETH, the price of ETH is going up, but you're gradually accruing less and less ETH in your liquidity position, if that makes sense. So, and the tighter your liquidity position is, the more quickly you're selling off the better performing asset for the underperforming one. So if ETH is pumping, you're quickly selling off the ETH as a liquidity provider and accruing more USDC. But in exchange for that, you are accruing more in fees. But oftentimes the fees are not able to offset the divergence losses. So for ETH USDC, when we backtest these strategies, it's more often than not a much wider range than, let's say, a stablecoin pair. And we manage two different ranges at once. We have a wider one, which with a certain percent of assets, and we have a narrower one, which with a minority of the assets are provided in. And so we get sort of the best of both worlds, and we backtest these strategies over the course of a year where it experiences all sorts of volatility in the crypto markets. And we have a separate server that we're running these backtesting scripts on. So it's constantly downloading new data and optimizing for the right strategy for certain of these pairs. But that's essentially, I think the basics are, for depending on how volatile the pairs are, is going to dictate what strategy we put in place. More volatile, typically wider bands. Less volatile, narrower bands. That's the basic principle.
Yeah, I think that was very well explained. Providing liquidity is usually not an easy topic to break down, but I think that was wonderfully done. I just want to add to that. So let's assume I am providing liquidity in a tight range. What would happen if my LP, if the price is moving out of that range, what would that mean for me as a liquidity provider?
So once it's out of the range, that means you will then be single-sided in your liquidity pair, and you will stop earning fees. So you're only earning fees when your liquidity position is in range. And essentially let's say if you're providing liquidity from, let's say ETH USDC again, from 2,500 to 3,500, and the price of ETH moons all the way to 3,600, that means you've completely sold all the ETH in your liquidity position. So your liquidity position is left only with USDC, and it's not going to be earning fees again unless the price moves back into your position. So that's basically how it works.
Right. Also, then you will be holding USDC while ETH in this example has, of course, appreciated. So not an ideal scenario. Right. It is
exactly
something, to be avoided, essentially.
Right. So in certain cases, it might make sense because let's say for an LST asset, for LST pairs, we manage based off, there's an on-chain exchange rate where, users, like people who hold, let's say, wrap stake ETH or an LST, they're able to immediately exchange wrap stake ETH for the underlying ETH through the Lido smart contract at a certain rate, right? And what we'll do is we'll manage liquidity at that rate, and occasionally you'll have like an irrational sell where it's going to push the price out of our liquidity range. But in that sort of case, we would not follow the price downwards because it's our thesis that the price should that there's going to be some arbitrageurs that come in and they're going to arb the price right back into range. So if we were to have rebalanced lower in that case, what we would have done is we would have essentially sold wrap stake ETH at a discount or under the market value by rebalancing lower. And then once it gets arbed back and we rebalance back upwards, essentially we would have locked in quite a bit of divergence costs. So if you know that the price should be trading here and prices will get arbed, it's better to let the price just go out of range because it's going to come right back in range soon. But generally for volatile assets where there isn't really an on-chain sort of exchange rate where people are arbing, we would use, we would follow the pool price in most cases. For a lot of smaller markets where there isn't enough arbitrageurs, we'll also employ that same sort of strategy where, we'll have some sort of depeg protection. Like if ETH is trading at 3,500, but maybe some smaller network or maybe where there's not enough arbitrage volumes that are coming in and the price just dips 20% lower than anywhere else, in that sort of case too, we wouldn't rebalance lower because it's our expectation that some arbitrage trade will come in and move the price back in range. So it's not worth suffering the divergence costs to rebalance lower than rebalance back once the arbitrage trades do come in. But generally, that is correct. if the prices are moving and, it's a legitimate move where all the major exchanges, Binance, Coinbase, and and Chainlink are all saying the price is this, it's probably better to rebalance your position and make sure your liquidity range is encompasses the current price.
Yeah, interesting. I mean, it makes sense to me that you avoid a rebalance if it is at a unfavorable price when the expectancy is that arbors are going to indeed bring it back to the, fair market price.
Exactly.
Yeah, very interesting. Cool. You have tapped onto something here that I wanted to discuss with you as well, and that is basically the cost of attracting liquidity. So every issuer of a crypto asset, of course, has to, usually wants to find a way to make it tradable. If you want to make it tradable on a decentralized exchange, what you need is liquidity. And that brings us to the question here. Like, what is the problem and the cost that is associated with attracting liquidity? Can you walk us through that existing problem a little bit, and then we'll discuss the solutions to that?
Yeah, I guess the cost of attracting liquidity today is, I think like the most predominant form of liquidity. The reason why people suffer costs is exactly what I mentioned before in terms of the divergence costs. Is you're always short volatility, and especially in the crypto markets, there's a lot of volatility. So, as we mentioned with that simple example, when the price goes out of your range, let's say if the price of ETH goes to the top end and beyond your range, you're essentially all in USDC and you don't have the upside of ETH as it goes higher beyond the upper side of your range. So that's one side, that's just the cost of providing liquidity, and vice versa. If the price were to completely dump in price, so let's say if ETH were to go much, much lower, your price, once it goes to the bottom of your range, you're 100% in ETH and you're fully exposed to the downside of ETH versus, let's say if you're 50-50, you're only 50% exposed. Now, once it gets to the bottom of your range, you're 100% exposed to the downside of ETH, and while also not earning any fees. So these are like the typical costs of providing liquidity, which translates into the cost of attracting liquidity. So it's, how do you make it so that it's worthwhile for these liquidity providers to provide liquidity? And I think, the most predominant form today is you see on all the large networks like Arbitrum, Optimism, and all the other L2s that are popping up. They're all looking to incentivize liquidity because the liquidity that people provide, the lower price impact that you have, attracts more whales. It makes it cheaper for larger purchases to take place. As I mentioned before, price impact is a pretty big thing. So if you have more liquidity around the current price, you're going to attract larger traders because they could trade with less price impacts on their trade. So that's sort of the, I guess, the benefits of having liquidity, but you're going to have to pay a lot of today's, you're going to have to pay the cost of providing the liquidity providers sort of the offset to the divergence costs they could potentially suffer, especially for maybe networks that don't quite generate enough in fees. A network that generates a lot in fees, this is the amount of incentives that the network has to provide is maybe a little bit less because a lot of the payment to the liquidity providers can be supplanted with fees versus the incentives. But aside from that, there's a lot of different ways that you can hedge LP positions that doesn't require additional incentives and rewards. But on the flip side of that requires a lot more liquidity and potentially other financial instruments. Like with options and with power perpetuals, you could essentially perfectly hedge the divergence costs that you have in your liquidity positions. The only issue today is there's not enough liquidity in options products and power perps products. So it really just doesn't make sense. Like you'd be trying to hedge maybe 20%, 30% divergence costs, but you end up paying, let's say, 45% in funding. So just the math just doesn't quite work out. But I think that for now, I think the liquidity incentives are kind of like the best way of hedging those losses. But I think in the future, once the DeFi ecosystem matures and we have more liquidity in these financial derivatives, I think there's going to be a lot more options available.
Yeah, very interesting to see that you're keeping tabs on that. So when that option becomes available, I would probably hear from Gamma Strategies that this is being incorporated in some way, right?
Yeah, definitely. I mean, we're always looking into that right now, and even without those options, you could get to like imperfect hedges with certain lending markets, even just normal, perpetual markets. Because at the end of the day, you're short volatility with your liquidity position. So if you can find ways to go long volatility, there's ways that you could hedge.
Yeah, that makes sense. I mean, being short volatility is usually something that people, do not want to do being in crypto. And so that, of course, then necessitates that there is some incentive for people to actually provide the liquidity. Few people do it out of the goodness of their heart to enable other people to trade with less slippage. So let's take the perspective of a AMM here in this instance. You want to attract liquidity so that people use your AMM. You're able to swap there without high slippage, but that of course requires token incentives. So I'd be interested in your take here, like what is a way that decentralized exchanges can attract liquidity without giving out unsustainable rewards? There has to be some sweet spot in between. What are your thoughts on that? And I see we just dropped you. Let's get you right back on stage.
Hi
And
there.
you're back. Hey, Brian.
I think I might have gone disconnected for a little bit, so I didn't catch hopefully you guys got my last response, but if I think you asked another question with regards to, do you mind just maybe repeating the last part of your question?
Yeah, sure. So basically where I wanted to take you is to take the perspective of an AMM. If they want to attract liquidity, they of course have to give out some incentives.
Yeah.
Usually they are finite or, ideally, let's leave the tokenomics out of that. But what is the best way for decentralized exchanges to attract sufficient liquidity without burning through their incentives way too fast?
Yeah, I think a lot of DEXs uh can sort of improve in this regard, but a lot of times it depends on the type of DEX too. But a lot of times I see, people incentivize. I think if you can tailor your incentives towards the fees that the positions are earning and the value that's being accrued to the DEX, I think the better. Because a lot of times I see like 20K of incentives go out per week for a liquidity pool that maybe generates me $18 in fees. So I think but sometimes that's important, and maybe there's reasons for having more liquidity there. But I've seen different models of DEXs like VE33 DEX models that was popularized by this DeFi builder back in the day, Andre Cronje. He created a DEX model where all the fees go to the token holders, and the token holders vote for certain incentives to go to a certain pair. I think that the verdict is still out on whether that's a sustainable model or not. I think that's a lot of issues today, is just understanding like how that we can survive with that. I think a lot of people are either um like one way is like if the fees generated is equivalent or greater than the amount of incentives being provided, then that would be a net positive. Or if certain external parties who have interest in having liquidity for a position that may not generate enough volumes, but are willing to pay for that because that provides some value to that particular network or particular project that wants that liquidity. For example, let's say there's a lending protocol that wants deep liquidity for maybe their stablecoin, their CDP-based stablecoin that maybe doesn't generate a lot of fees, but it just provides value for that lending protocol. Then they may provide additional funds for providing that liquidity. I still think there's not enough solutions out there for where liquidity is very, very much needed, and maybe it doesn't generate much volumes, but it does provide some amount of monetary value for a particular project, and it's really finding ways for that particular project to reimburse the liquidity providers. And I think just connecting those things together is like, who needs the liquidity and how can we get the person who needs the liquidity to pay for that liquidity? I think that's a more sustainable model in the absence of these instruments that I was talking about earlier that can help, offset the cost of providing liquidity.
Yeah, very interesting take. And I think it's very interesting bringing the V3 model into the mix. It seems like the market has not yet decided on there is only one valid way of doing an AMM or DEX. So yeah, very interesting to see all of these competing systems out there. And it seems like, to me at least, a clear winner has not yet emerged.
Right. I think where you do see a lot of profitable DEX is like, I think the DEXs that have maybe some connection with like market makers. I know Base, right? They have like feeless withdrawals from Coinbase to Base. And so a lot of the market makers are doing arbitrage trades. And so you see on Base chain, there's like an insane amount of volumes, especially for ETH USDC, where I think they do like over 200 million of volumes on per day on 30 million of liquidity. So something like that, I mean, it's 100% going to be net positive to that DEX to incentivize that. Like the fees are far going to outweigh the incentives, but I think it's just making it more easy for people to trade on your particular exchange, getting more market makers, getting larger whale trades involved. I think all that is sort of factors into the analysis as well on how DEX can be more profitable.
Yeah, absolutely. Speaking of the DEXs, I mean, there are quite a few that are already integrated with Gamma. So the question that I wanted to close our discussion around is with what does it take for an AMM to be successful? We already touched upon the incentives being calibrated somewhat well, but yeah, any other advice or learning that you have accrued over the years?
Yeah. I mean, I think there are a lot of unsuccessful AMMs, but I think the successful ones are I think it's twofold. Like there's certain DEXs that are very, very good at business development. I would say like Fina on BNB chain. They have a fantastic BD team. And so they're a VE33 model DEX where they're looking to partner with as many different projects within the ecosystem, and those projects who require liquidity are willing to provide their own incentives and bribes to have liquidity for those certain pairs. So they're able to leverage the needs of other projects within the ecosystem to make their own DEX more sustainable today. I think that's where and they have a fantastic BD team. They have a lot of projects that they're integrated with that are willing to bribe on their exchange. So I think that's one example of a successful V33 DEX. On the other side, I would say like Velodrome and Aerodrome on Base Chain and OP Mainnet. They're very, very successful. For the longest period of time, they were just very good at governance, where they were able to just get a lot of money from the respective network they're on, and they were able to incentivize pairs, but they weren't as capital efficient until very, very recently. But they were able to use those funds to build their own their own version of concentrated liquidity, and within the last like 3-4 weeks or so, their model has really proven itself to work. Uh, they've they've They were able to get very concentrated liquidity. They were able to kind of calibrate the rewards extremely well to where the volumes were flowing, which is namely ETH/USDC, and they're now the most successful DEX on both OP mainnet and base chain. And they were able to do this through, I think, just building a really good concentrated liquidity product, but more importantly, incentivizing the right pair that was generating a lot of volumes. They were able to take advantage of the fact that a lot of Coinbase market makers are now doing arbitrage trades through their DEXs in particular. I think in the future, now with more modular type AMMs like Uniswap v4, Algebra Integral, where you could insert any sort of arbitrary logic before and after pool events, I think that part is going to be more important to attracting larger volume trades. You could give trade fee discounts to larger trade sizes. You can maybe even whitelist certain market makers to do trades on your account, to do trades on your DEX to increase volumes. You could give liquidity providers maybe additional incentives to based off the length of time they've been providing liquidity, because stability of liquidity is good. So I think those are the ones that the examples I mentioned with Dina and Aerodrome, I think, are the most successful ones I've seen today. But I think in the future, I think it's going to be a little bit more granular, a little bit more surgical on how DEXs are going to be able to attract volumes, and the ones who attract volumes are the ones I think are going to be the most successful, or the ones who are integrated with as many other protocols that are looking to add additional value with incentives because they find value in having that liquidity, even though it doesn't, generate much volumes. I think those are the types of DEXs that I think are going to be successful.
Yeah, awesome. Thanks for that. Even the Uniswap v4 changes. First time I'm hearing about them. So I was having the idea to be leaving this space smarter, and this is certainly something that I'm going to take away. I'll have to look into that. That sounds very interesting. And of course, then by extent, going to be interesting to see, Gamma strategies incorporate all of these upcoming innovations. So yeah, very excited to be staying on top of that. Thanks so much, Brian. I think it's a good time to let anybody on stage that wants to ask a question, then now is your chance. And if there is nobody raising their hand, I think that just speaks to your concise explanations. And also we have been competing with the Milan Fashion Week, the European Union Cup. I think we did exceptionally well with the turnout. And yes, I think we are just going to take it as the compliment it is that you have been doing a great job explaining these concepts, breaking them down. Mission accomplished for me. I am feeling a little bit smarter already. Brian, just tossing the ball back to you. Like, what is the best place for people to learn more about Gamma strategies, how to get involved? That's your chance to aggressively shill all your socials.
Yeah. So all our socials are at Gamma Strategies. So if you go on Twitter, probably our main source of information is on Twitter at Gamma Strategies. If you want to go to our web app directly and see all our pairs that we have available, it's app.gamma.xyz, and feel free to check out our docs page. It's pretty extensive. It's really tailor made to people who are getting a first intro to Gamma. So I'll check that out at docs.gamma.xyz. And yeah, that's pretty much it.
Awesome. Thank you, Brian. And thank you to all our listeners. We will have another episode coming up next Tuesday already. So mark your calendars. And for now, that just leaves me with saying that this episode of Buildsphere has, of course, been only for informational purposes. And with that, thank you, everybody, once again, and have a great evening. Hopefully see you around for the next episode. Bye-bye.
Thank you so much. Bye-bye.
Take it easy, Brian. Bye.